Historically, when business owners looked at the alternatives available with respect to selling their company and transitioning and succession planning, the perception has always been that third-party sales were not going to generate the same kind of value or that third-party sales would create greater value, excuse me, than a sale to the employees. And in large part, I think that was due to the fact that most employee sales historically had been rather friendly transactions where the business owner wanted to reward the employees, pass on the business, still take something out of the value that he or she had created over the years, but certainly wasn't looking necessarily for a market level transaction because for the most part they didn't believe that was available. And historically, when you think about it, that was probably true up until the implementation of the Employee Ownership Trust in the Finance Act 2014. When you think about it from a valuation perspective, trade buyers have always been viewed as the one buyer that was sort of the holy grail. They could pay a higher price than other types of buyers, private equity or individuals who might be interested in purchasing someone's business, because in theory they could realize some synergies that would increase the cash flow, that would increase the profitability, and would then allow for a higher purchase price while still earning an appropriate return. And there is some truth to that. There are going to be circumstances where a trade buyer is going to see the opportunity for very significant synergies and is going to be willing to pay a price that an EOT, private equity, or an individual purchaser just can't pay and still earn a reasonable return. So there will still be that case. With respect to private equity buyers, typically use significant debt to finance their acquisitions. So what they can do is pay a higher price than some other buyers and still achieve a target return on their equity because the capital structure is comprised of more debt than equity. So when they look at their limited partner returns, they can still pay a reasonable purchase price for the company and still earn that adequate return because they don't use as much equity as another buyer might. So while in a general sense, those valuation views may hold true, that doesn't mean that they're always correct. Because the one thing to keep in mind is that what you keep is far more important than what you get. And I know that sounds like common sense, and it's something that when you think about it, certainly is going to ring true. But in a lot of cases, it's difficult to get past that initial, gee, if I sell to a trade buyer, I'm going to be able to make more money out of the deal. And as we walk through the rest of the webinar, we'll show you why what you keep may be higher with an EOT transaction than either a trade sale or a private equity sale. So when you look at the EOT sale, we feel it's very compelling. I touched a little bit on this, but valuations can be very competitive. Again, you're probably not going to necessarily beat the gross valuation in a trade sale, but you can certainly be very competitive with private equity when you look at an EOT transaction, because the EOT is really just a financial buyer, similar to an extent to the private equity buyer. There is a difference in terms of how you can structure the transactions and whether or not you can deduct interest expense to the extent permissible, which you cannot with an EOT sale because of the way the transactions are generally structured. There are a couple of cases where you can structure it to achieve some corporation tax deductions for interest, but it's not common. One of the real keys, and again, these aren't necessarily tax-driven transactions, and nor in our view should they be, but at the same time we have to be realistic and say that without a willing seller, there are not going to be employee-owned businesses. So part of I think the attraction of the EOT sale is that there are some very significant tax benefits, which we talked about a little bit in our last webinar. But as part of that transaction, with the EOT sale being CGT free to the vendors when they sell a controlling interest, If there's excess cash on the balance sheet, and by excess cash, I mean cash that's not needed for use in the business on an ongoing basis, that's not needed for capital expenditures, that excess cash becomes part of the purchase price of the company. So if you look at how you calculate the value of the company's equity, it's going to be generally based upon some kind of a multiple of cash flow or profit. In a lot of cases, you'll use EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. Think of that as a proxy for operating cash flow. So it'll be a multiple of EBITDA plus excess cash less any debt on the company's balance sheet. So that's sort of the equation that takes you from what we call enterprise value down to equity value, which is what somebody would pay for the company. So the key here is that excess cash, rather than being paid out as dividends subject to a tax of 38.1% for additional rate taxpayers, now comes out of the business tax-free. There's no income tax on it. There's no CGT on it, provided you meet the qualifying requirements for an EOT transaction. This can be very significant. We've had clients that have had in the past, several million pounds of excess cash that they never distributed out of the business, that when they did their EOT, they were able to take out tax-free, and that obviously provided a significant benefit to them. In terms of the transaction itself, it's a much more, I think, controllable, a much simpler, and a much less expensive transaction than a third-party sale. If you are going to finance this 100% using vendor financing, in that case, you truly, as the seller, would control all of the aspects of the transaction. Where that changes a little bit is if you're using third-party capital, because at that point you need to go through a process with a lender or with lenders to raise the money that's going to support the transaction. So you do have some outside involvement, and you are subject to some outside variables at that point. But for the most part, you're going to control all of the major aspects compared to a third-party sale. Timing-wise, it's a much faster transaction, all things being equal. If you're going to do a transaction that you finance 100% as a vendor, we've actually closed one in as short a period of time as 5 weeks. We did that before the Christmas holidays a few years ago. So it can be done. I wouldn't recommend that kind of a compressed time frame to anybody, but if you think 8 to 12 weeks for a vendor finance transaction, that's going to be reasonable. And it's going to take significantly longer than that for a third-party deal in most cases, because you have to go through a process and you can't control the timing on the part of lenders. If you do have a friendly lender that you've got a relationship with, or your current bank, that again can be significantly shorter. But if you need to go out to market, it is going to take additional time. We mentioned up here 9 to 12 months for a third-party sale. That can be optimistic. I've seen situations where the process dragged out over a couple of years in the past. So whether or not you're talking about 16 to 20 weeks versus 9 to 12 months, the takeaway here is that it's going to take a significantly less amount of time to complete an EOT transaction than it typically would a third-party sale. One of the other items that it comes a little bit of a surprise to vendors is any transaction, whether you're going to be using third-party debt in conjunction with vendor financing or all vendor financing, is that you can structure the vendor financing on commercial terms. And when we say on commercial terms, we mean with the repayment structure and the return structure that a third-party lender would require to provide the same type of capital. So if you're looking at doing a vendor financing piece in conjunction with third-party debt, you in effect would become the subordinated debt that fills out the capital structure, and in that case earn a return somewhere in the 10 to 12% range through a combination of interest and then a sort of a deferred consideration payment that would bring the overall return up to commercial subordinated debt levels. If you do the transaction with 100% vendor financing, again, you can structure it with a piece that looks like senior debt, a piece that looks like subordinated debt. again, so the economics are such that you get commercial returns for taking the risk of financing the transaction, which we think is only appropriate. One of the other points to bring up here, I mentioned in the third point from the bottom that there's no risk of capital gains tax relief clawback after the year of completion and in the next tax year. If there's a disqualifying event with an EOT, the revenue can come back and require repayment of the capital gains tax that would otherwise be due, but that's only during the year of completion and the year following completion. The most common disqualifying event would be a sale of the company where the trust no longer owned a controlling interest. So let's say you sell the company to an EOT. Next tax year, you get just an outrageously attractive offer to buy the business. The trustees say this makes perfect sense. We need to do this. It's better for the employees to do this. If that happens during that time period, then the vendor is going to be on the hook for the CGT clawback. You can mitigate that by putting a consent requirement in while you're still owed money as a vendor that would require you to approve any transaction, because obviously you don't want to incur the clawback if one of the motivations was to take advantage of the CGT relief. Once you get past this time period, then the clawback becomes the obligation of the trustee and the trust. So when the company, if the company is sold at some point in the future, then at that point, the trust, as part of the distribution of the sale proceeds, would need to pay the capital gains tax from the original transaction, plus any capital gains tax due to the increase in value over time. One of the other questions that we do commonly get is, if I go down this route, can the company be sold later? And the answer to that is absolutely yes, because all you're doing in this particular case with an EOT sale is swapping out shareholders. So you've taken the vendor or the vendors and in effect swap them for the trust as the new controlling shareholder. So doesn't preclude in any way, shape, or form selling the company at some point down the road. My guess is that, based upon my experience with the ESOP in the United States over the last 30 years, is that, at some point, many EOT companies will be sold just as part of the normal life cycle of a business, and there's nothing that would preclude that from happening. In fact, there is a benefit to the employees, with the EOT structure, in that if that does happen, they share in the proceeds of the sale, along with any vendor shareholders that may remain as minority shareholders in the business. So there's a nice benefit for the employees, if that does occur at some point in the future. One other point, if you're looking potentially as a vendor at selling to the management team, an EOT can accomplish that in a slightly different manner, because what you can do is self-control from a voting perspective and a technical perspective to the trust, where it does hold a controlling interest. You can sell shares or use EMI options if the company qualifies to get direct shareholdings into the hands of the management team. And then the management team has operating control of the business going forward, because the EOT itself, is a passive shareholder. It is not going to try to interfere in the management of the company and get in the way of the management team doing what it needs to do to manage the company effectively going forward. So let's talk a little bit about the key advantages of the EOT transaction. So in the first bullet point here, there's probably a term that some of you may have come across over the last couple of months, but many of us still refer to this as entrepreneurs relief. But with the change in the title, entrepreneurs relief is now called business asset disposal relief. The economics are now even more attractive with the EOT transaction than they were in the past. Previously there was a lifetime allowance of 10 million pounds of gains that you could shelter with entrepreneurs relief and pay a 10% capital gains tax on that if you had qualifying assets that you sold. And in most cases, that would be someone's business. Well, that lifetime allowance has now been reduced from 10 million pounds to 1 million pounds. And when we go through the examples that will follow, you'll see that the capital gains tax now from selling to a third party is significantly greater than it would have been in the past where you had that higher allowance. Because what's happened now for additional rate taxpayers is that the CGT is now going to be 10% on the first £1,000,000, and it's going to be 20% on any remaining gains above and beyond that first £1,000,000. So there's a significant additional cost to selling to a third party. You don't need to engage with any third parties in what we call a distracting adversarial sale process. If any of you have explored potentially selling your business, you know that it can become a pretty draining process. Everybody wants to win when you're looking at a third-party transaction, so you'll tend to just go through and negotiate virtually every item possible as you're trying to get a deal to completion. And it can be a draining, distracting, and in many cases unsuccessful process. So there's no need for that with an EOT transaction. You don't need to share any of your internal confidential information with competitors. If you run a process for third parties, you'll find in many cases everybody in your industry will want to be part of that process because they want to take a look at your numbers. They want to take a look at potentially your client lists, try to understand your margins, how you price products or services, and there's only going to be one winner, if there is even that one winner in that kind of a process. But your competitors have, for the most part, gotten some really good insight on how you do business and what your profit looks like, and in some cases who your clients are. You don't have to worry about any kind of post-sale integration issues. Post-sale integration issues, when you think about that, in many cases can include redundancies. And for those of you that may have been through this process, I'm sure you will see that, or have seen that, the redundancies very rarely occur at the buyer. They will typically occur at the acquired business. So post-sale integration in many cases can mean a loss of jobs for the company being purchased. And that's the last thing anybody usually wants to see when they start going down the road with transition planning. You can provide long-term stable ownership. If you're interested in building a legacy in your community, this is one way to do it. As I mentioned earlier, if the company is ever sold, the employees do get to share in the sale proceeds, so that can be a very significant factor. And this also, depending on who you're looking to hire and what their interests might be, can serve as a differentiator, because in many cases, key staff want some kind of equity in the company. And you can offer tax advantage share schemes alongside the EOT. And if somebody is going to join a business and leave another job, they typically want some kind of a sense that there's going to be stability. And this can be that kind of a differentiator with respect to bringing key staff on board going forward. So let's get into some numbers now. We'll walk through some examples here, and we'll look at the third-party trade sale, we'll look at a private equity transaction, and we'll look at an EOT transaction and sort of walk through, what the cash flows look like, who gets what, and how that works out in the end. And then we'll go through a comparison of proceeds that will, I think, make that point I mentioned earlier, that the gross proceeds to a seller can be equal to or greater with the EOT transaction than any kind of a third-party sale alternative. So in terms of the core assumption for the third-party sale, we're going to assume EBITDA or operating cash flow of £3 million, as you can see here, a 7 times multiple, which is a little bit higher than a normal market multiple might be for a financial buyer or the EOT, as you'll see. So we assume no debt or excess cash, and that gives us equity value for the company of £21 million. In this case, we're assuming we have 4 shareholders, and this assumption is obviously going to carry through in the other examples. And the ownership percentages were chosen intentionally to show the impact of shareholdings and then the business asset disposal relief. So shareholders 1 and 2 are above the 5% threshold required to qualify for the business asset disposal relief. Shareholders 3 and 4 are below that threshold, so they would not have been able to take advantage of the CGT anyway in this particular case. So if we look at shareholder 1 in this example, with 68%, the equity value of shareholder 1's interest in the company is just under 14.3 million pounds. Shareholder 2 is just under 4.9 million, and shareholders 3 and 4 own equity that's worth 945,000 pounds. We're assuming there's a zero basis in their shares, which means, the cost of the shares to them was zero. So in effect, they were in the company from the time it was founded. And again, that assumption is going to hold as we walk through the other examples. So you've got a taxable gain then that's equal to the amount of the proceeds from their equity sale. So in this particular case, then we have to first calculate the CGT on the first £1,000,000 of gain, which is the amount that qualifies for the business asset disposal relief. So for shareholders 1 and 2 who can take advantage of that, they would pay £100,000 on the first million. Then they would pay 20% capital gains tax on the remaining value, which you can see is a significant amount. So in this case, shareholder 1 is going to pay just under 2.8 million pounds of capital gains tax. Shareholder 2, 866,000, and then 3 and 4 don't qualify for the business asset disposal relief, so they're going to pay capital gains tax, assuming they qualify as additional rate taxpayers, of 189,000 pounds, which is going to be 20% of their taxable capital gain. So after subtracting the capital gains tax, you can see the net proceeds to each shareholder as we go across toward the lower part of the middle of the page, ranging from 11.5 million pounds down to 756,000. So we have a total capital gains tax in this case of 4 million pounds. And all of a sudden now our equity value of 21 million pounds in this case has been reduced to after-tax proceeds to the vendors of 17 million pounds. So that's a fairly significant hit to the shareholders as a result of the capital gains tax they have to pay due to the third-party sale versus the EOT transaction. And then the bottom part of this actually just shows the calculation of the capital gains tax down there in a little more detail. So this is our first example. So and we'll summarize these on a slide as we go forward. But again, 21 million pounds after tax becomes 17 million pounds with the third-party trade sale. And again, you remember we have a multiple here of 7 times operating cash flow. So with the third-party private equity sale, we're looking at the same basic assumptions, with the exception that we're now reducing our multiple from 7 to 6.5. Doesn't matter particularly if we go 6.5, 6. The concept is that private equity is generally going to pay less than the trade sale buyer, unless you're looking possibly at a platform acquisition for private equity. And by platform acquisition, we mean a company that they're going to use as the basis to build out a bigger company. So it's kind of the starting point in building a larger business in the same sector. But for this purpose, we've assumed that the private equity multiple will be 6.5 times. That leads us to an equity value, again, under the same assumption of no debt or excess cash, of 19.5 million. You can follow the same cash flows and logic through the center part of the slide, where we have our 4 shareholders with the same ownership percentages. You can see the equity value now based upon the lower equity value for the company as a whole. We go through the same type of calculation with respect to the capital gains taxes. And you can see now the summary in this particular case is we have a total capital gains tax payable for our 4 shareholders of 3.7 million pounds, down slightly from the trade sale because our overall value went from the 21 million down to the 19.5. So our after-tax proceeds with the private equity sale go from 19.5 million down to 15.8 million. So it's less, which you would expect, generally speaking, with private equity transactions versus the trade sale. The proceeds would be, somewhat less than they would otherwise be. Okay, so that's scenario 2. Now we go to the EOT transaction. So with the EOT transaction, we've taken an even bigger haircut on our multiple. So we have operating cash flow or EBITDA of 3 million times a multiple now of 5.7 times. That now leads us to equity value of 17.1 million. But the big difference now that you'll see here and this is the motivation that the EOT structure provides, is that there is no capital gains tax due for any of the sellers with the EOT transaction. So in this particular case, our equity value on a gross basis becomes our after-tax value on a net basis for all of our shareholders. So 17.1 million sale value remains 17.1 million proceeds to the vendors because there's no capital gains tax due, even for our 4.5% shareholders. So there's no need to qualify at the 5% threshold for the business asset disposal relief. Nobody pays any capital gains tax in this transaction, which is very attractive to the vendors. So in this particular case, you can look at this compared to the 21 million equity value in our trade sale, and the net proceeds you'll see as we go through the next couple of slides are very similar. One thing I wanted to touch on a little bit right now, given what's going on in the world and in the economy, is we're looking at multiples here that are what I would say are probably pre-pandemic type multiples. If you were to look at going to market now with the business, obviously you may have been performing very well up to the point that we hit in February and March this year. Many businesses we work with had very strong 2019s. They had gotten off to a really good start this year, and then all of a sudden with the lockdowns, things have changed. Now, that doesn't mean necessarily that valuation multiples are going to be permanently lower. What it may mean, and again, it's going to depend upon your buyer, and it's going to depend upon a third-party valuation, which we think is mandatory with respect to EOT transactions. It may mean that your upfront multiple is going to be reduced, and it may be reduced off of a lower operating cash flow or EBITDA number at this point in time, and until the economy starts to recover, and in fact does recover. But that can be addressed in a couple of ways through either some deferred consideration that over a certain period of time there would be an additional payment made if the company ramps back up, through an earnout that over a period of time there will be incremental payments made based upon certain benchmarks of achievement. So while we're assuming in these cases multiples up front, the initial multiple of what you get that's guaranteed may be less if you're looking at doing something right now, but you can build in some mitigators that would pay you additional value if in fact your company does recover the way you, I'm sure, hope it does going forward. The problem with that from the EOT perspective is, we'll get a question from a business owner that says, well, if I only sell a controlling interest right now, which is 50% plus a share, and I hold on to the rest, is there some upside to me there? And the reality is, depending on the recovery, there might be, but what you're giving up is going to be the CGT relief if you don't sell the rest of those shares in the same tax year that you sold the initial controlling interest. That's one of the, I don't think I want to call it a downside necessarily, but that's one of the restrictions of the CGT relief, is that the CGT relief is only available in the year that control passes to the trust. So you're better off structuring this potentially as a 100% sale, even at what could be a lower upfront multiple, if you can build in the appropriate upside from a valuation perspective. One of the challenges that we think business owners are going to face based on a lot of the conversations we have is, if you've got someone who has built a company and they're now looking at the company's earnings being depressed as a result of the pandemic, they may be anywhere from late 40s to late 60s. Some of them may not want to deal with the challenge of rebuilding their company over a 3 to 5 year period as we come out of this. And not every company is going to go through that. Some will bounce back much more quickly than others. But there are going to be a number of business owners, in our view, that are going to look at this and say, you know, if I can get a fair value for this, build in some upside, this is probably the way to go, because I built this company once, maybe twice going through previous recessions, and I'm just not sure I want to do it a third time. And that's very understandable. And there are some ways we can mitigate that, and I think come up with some options that preserve some value while letting you still transition and take advantage of the tax benefits that the EOT sale offers. So as I mentioned when we started, the highest valuation doesn't always give you the most. So if you focus on what you keep rather than what you get, you'll find that the EOT transaction can provide you with more from a net proceeds perspective than the other sale alternatives. And again, every circumstance is going to be different. Every business is going to be different. So in our summary table on this slide, you can see the assumptions that we made in our 3 previous detailed slides with the trade sale, private equity sale, and EOT. So our multiples of 7, 6.5, and then 5.7 run across the top there. The real takeaway here is if you look at the bottom, you know, the EOT sale at 5.7 times operating cash flow or EBITDA is going to give you very much the same proceeds that a trade sale at 7 times is going to provide you, given the tax benefits of the EOT transaction. Yeah. So these numbers were obviously chosen, you know, somewhat intentionally to sort of give you a sense of what a break-even point might look like in terms of a difference in multiples. So, you know, roughly, if you look at this, and again, I can't emphasize enough that every transaction is going to be different. So from that perspective, you know, you don't want to necessarily get caught up in these particular multiples. They're going to vary a bit for your company, just pure and simple. They're going to vary. But generally speaking, in this case, we're showing that an EOT sale at 5.7 times is going to generate roughly the same proceeds that a trade sale at 7 times, and certainly exceed the proceeds by a significant amount from the private equity sale. Again, so focus on what you keep rather than what you get. Okay, so excuse me. So how do we structure this then? Because this is key to additional proceeds. When I mentioned the commercial returns earlier with the vendor financing, you know, understanding how the EOT sale is structured can be very important in looking at what your proceeds will actually be from the transaction. So again, just to summarize the EOT sale, it's operating cash flow or EBITDA of 3 million pounds times 5.7 times. So we have an equity value of 17.1 million pounds. So in this case, what we're assuming to finance the transaction is that you're going to be able to raise 7.5 million pounds or 2.5 times EBITDA senior, think of that as bank debt. And then the vendors will take back or provide seller financing in the amount of roughly 10.2 million pounds. So that's how you would finance the transaction. So the vendors will be behind the bank. They will be able, in most cases, to receive interest payments on an ongoing basis, but they won't be repaid the same way the bank debt will be repaid. So the bank debt will typically be paid down, let's say, over a 5-year period, and then the vendor loans would be refinanced by bank debt. And at that point, the vendor would have been completely paid out, and the trust, and then the company which provides the funds to the trust to repay its debt, will then pay off the new vendor loan or the new bank loan over another 5-year period. So initially, the vendor is going to be a subordinated debt provider in this case. And again, if you remember, we talked about a subordinated lender earning returns in the 10 to 12% range. And so how does that happen then? So in this case, again, just to summarize on the right side, then you'll purchase the shares for 17.1 million pounds. You pay transaction fees and expenses, in this case of 562,000. That number goes down significantly if there is no third-party debt, because you've got, in this case, you've got additional lawyers, you've got due diligence, you've got commitment fees or closing fees on the lender's part. So don't let that number scare you, because you know that can be managed down significantly based upon how you structure the transaction. So let's talk about how the vendor then gets that 10 to 12% return. So if you look at this, we're assuming, and we backed into this 10% deferred consideration percentage, based upon, the target return of 10 to 12% for the vendors. So in this case, you can see we start in year one with the 10,162,000 pounds of deferred consideration. Think of that as vendor provided subordinated debt, and that's going to remain outstanding for 5 years while you're paying off the initial bank loan. And then at the beginning of year 6, that's going to be refinanced with new bank debt. So again, we're assuming that refinancing occurs after 5 years. During the 5 years, assuming you're in compliance with the bank covenants, with your senior debt covenants, you should be able to earn interest in cash on your subordinated debt. So what that means as the vendor is that, year 1 through 5, you're going to be earning interest on your subordinated loan of just over 700,000 pounds a year. Now, again, this assumes compliance with the bank covenants. As you go into the transaction, what you may find is the bank says, for the first year or two, we don't want to necessarily have that full amount paid out in cash every year. So what you may see is that the bank will say, subject to covenant compliance, we're going to allow you to pay out 50% of that in years 1 and 2, and then we'll allow you to catch up in years 3, 4, and 5. And then whatever is left at the end of that period will roll into the new bank loan, and you'll get full payment at that point. So what we're assuming then is you go through and calculate that final payment I sort of talked about. Think of it like an equity warrant. You were assuming EBITDA, or operating cash flow, grows at 2% a year over our projection period. You've got then at the end of year 10, EBITDA of just under 3.7 million pounds. We're assuming the valuation multiple has not changed. So we're not going to artificially create value with a higher multiple, because nobody has a crystal ball. You don't know what it's going to look like in the economy 10 years from now. So we're saying then that the enterprise value is going to be, just under 21 million pounds, which is up from our initial valuation of 17.1 million. We're assuming at that point you've paid off all of the debt. We're assuming that that excess cash has been used to pay off all the debt, so there is no excess cash at this point on the balance sheet. So the equity value is going to be the same as our enterprise value at this point 10 years in. The value of that 10% ownership stake then is going to be just over 2 million pounds. And then we're assuming this was structured where there is not going to be a discount for a minority interest at that point in time. There's no need to do that, because this isn't buying shares, first of all. It's a calculation of value. And because it's a calculation of value, it can be negotiated basically any way you want to negotiate it up front. It does need, obviously, buy-in from the trustee, but the trustee is going to look at this and say, this is what it would cost me if I had third-party debt instead of the vendor. So, maybe with a little back and forth, they'll agree to this type of structure, because the alternative, realistically, is you don't have an employee-owned company created through this process. So now, if you look at what we have for gross EOT proceeds, and this is sort of the magic of this kind of a structure where the vendor earns commercial returns. The vendors received 17.1 million pounds of value for the company at the time it was sold. They will have received over time 3.557 million pounds of interest, and then they would have also received 10 years out almost 2.1 million pounds of incremental value to the company, So when you look at gross proceeds, then the EOT on a gross basis is going to be providing 22.7 million pounds of value, the trade sale 17 million pounds of value, and the private equity sale 15.8 million pounds of value. So this is what I mean when I talk about the EOT transaction being able to provide the same, if not in a number of cases, much greater proceeds than a third-party sale would provide. Now, again, being just upfront and realistic, you will be paying income tax on the interest payments. There will be income tax due on the 10% stake down the road, because again, that's not true shares, that's an economic value calculation. But even so, you're going to be significantly better off with the EOT transaction in this particular scenario than you would with the other two sale alternatives. And again, I think if you're a business owner, what you would want to do in most cases is look at the alternatives. If you're working with an advisor, they can help you do that. That's the approach that we sort of take with a lot of our clients, is to look at what third-party valuations look like, to compare the EOT with these third-party options, because it's important that you don't have second thoughts if you go down the road with any particular transaction. So we want to walk through the alternatives, and most advisors would want to do this, that do EOT work as well as other types of corporate finance work, and make sure that this is the right transaction for their client, because it doesn't necessarily work for everyone. If you are someone who wants to walk away the day of completion, this is probably not the route to go, unless you've got a very strong management team in place that can take over and run the company from day one. In most cases, because you're going to have some kind of vendor financing outstanding, you're going to want to stay involved, or maybe even need to stay involved from a third-party lender's perspective for a period of time, to make sure that the transaction and the transition occurs smoothly, and that the company is able to continue forward as it has in the past, which makes any kind of a lender obviously much more comfortable.